Welcome back to Our Money News, where we decode institutional market intelligence for sophisticated investors. Today, we turn our spotlight toward an overlooked segment within the small-cap consumer durables ecosystem: companies engineering specialized home appliances, including water purification systems, advanced air purifiers, and automated vacuum cleaners. While mega-cap electronics brands dominate headlines, small-cap innovators quietly establish defendable economic moats by targeting high-margin niche categories. Think of an economic moat like a moat surrounding a medieval castle. The wider and deeper the ditch, the harder it is for rival knights to cross and raid the treasury. In the appliance sector, this moat is built through proprietary filtration technologies, localized supply chains, and specialized manufacturing agility that larger conglomerates often overlook due to scale constraints. To understand asset insulation in this category, we must dissect the dual growth engines driving valuation: health-centric filtration and automated domestic cleaning. Water and air purification devices are transitioning from discretionary luxury items to non-discretionary health utilities across expanding urban demographics. Concurrently, specialized vacuum technology is capturing premium domestic automation market share. From a capital deployment standpoint, these categories carry higher gross margins than standardized white goods like conventional refrigerators or basic fans. Consider a high-performance air filter. It operates under a razor and blade business model. Selling the unit is just the initial transaction. The recurring sale of replacement filter cartridges creates an annuity-like cash flow stream that insulates corporate earnings against macroeconomic downturns. Analyzing the first quarter operational cycle reveals significant top-line acceleration driven by seasonal demand spikes and expanding channel distribution. Top-line revenue growth across specialized small-cap appliance players demonstrated resilient double-digit expansion year over year. However, institutional analysts at Our Money News pay close attention to EBITDA margin quality. Think of gross revenue as the total horsepower generated by a car engine, while EBITDA margin is the percentage of that power that actually reaches the wheels to drive forward momentum. Operating leverage expanded notably as fixed overhead expenses were amortized across higher unit distribution volumes, allowing operating profit growth to outpace top-line growth despite minor raw material cost fluctuations. Diving deeper into balance sheet mechanics, working capital efficiency emerged as a pivotal differentiator during the quarter. In manufacturing businesses, working capital drag can stealthily choke expansion. It is like driving a truck with the handbrake partially engaged. If inventory sits idle in warehouses or distributors delay payments, cash remains locked away from productive capital reinvestment. Forward-thinking small-cap manufacturers improve their cash conversion cycle by optimizing component sourcing and enforcing disciplined receivables terms. This operational optimization generated robust free cash flow, reducing dependence on short-term corporate debt and reinforcing internal solvency metrics ahead of peak seasonal marketing cycles. Corporate leadership commentary during post-earnings conference calls reinforced a strong focus on strategic execution and disciplined capital allocation. Management highlighted aggressive investments in localized research and development to reduce reliance on imported circuit boards and specialized motor assemblies. Think of localized supply chains as installing a rainwater harvesting system for a farm. Instead of relying on unpredictable external rainfall, the business secures a steady, controllable water source directly on site. Guidance targets continued double-digit unit volume growth, accompanied by measured capital expenditures directed toward automated assembly lines, aimed at lowering unit labor costs and improving product yield quality. Examining the macro environment reveals powerful structural tailwinds driving the consumer electricals sector. Rapid urbanization, deteriorating atmospheric air quality indices in major metropolitan hubs, and rising disposable incomes have altered household spending habits. Premiumization is no longer just a buzzword. It is a structural capital rotation within consumer baskets. When consumers upgrade from basic appliances to smart, internet-connected air purifiers and robotic vacuums, manufacturers experience an upward shift in average selling prices. From an asset allocation perspective at Our Money News, companies positioned within this premium adoption cycle capture superior return on invested capital compared to legacy commodity manufacturers. Despite strategic momentum, sophisticated equity investors must rigorously evaluate downside risk factors. Small-cap appliance players remain vulnerable to raw material cost inflation, particularly in copper, specialized polymers, and electronic microcontrollers. Think of input cost volatility as an unexpected storm at sea. If a ship lacks heavy ballast, high waves can capsize its profit margins before the captain can adjust course. Additionally, intense competitive pressures from global consumer electronics giants entering niche purification categories could squeeze gross margins if price wars erupt. Regulatory shifts regarding water discharge standards and energy efficiency ratings also require ongoing compliance expenditures that could temporarily compress cash flows. Looking ahead over a multi-year horizon, earnings visibility for niche small-cap appliance players hinges on distribution network expansion and original design manufacturing execution. As these companies transition from regional market participants to national contenders, valuation metrics often undergo a breakout watch reassessment. When institutional capital recognizes that a business is moving from cyclical manufacturing to predictable recurring revenue models, market multiples expand. Evaluating price-to-earnings growth, or PEG ratios, provides a clearer perspective than trailing PE alone. If projected earnings growth exceeds 30% annually, higher initial valuations can be structurally justified by long-term capital compounding. From an institutional portfolio construction viewpoint, small-cap growth assets require systematic risk mitigation through position sizing. While the growth trajectory of water, air purifier, and vacuum innovators is compelling, asset insulation is best achieved by pairing these high-beta small caps with defensive balance sheets across a broader durables basket. Capital rotation dynamics suggest that institutional investors are gradually shifting capital toward consumer plays possessing strong pricing power and localized manufacturing advantages. Monitoring quarterly inventory velocity and channel checks will remain critical indicators for maintaining high-conviction positions in this fast-evolving consumer ecosystem. In summary, the small-cap consumer appliances sector presents a dynamic intersection of structural demand tailwinds, expanding operational margins, and high-margin product expansion. While short-term input cost volatility requires disciplined risk monitoring, companies mastering localized manufacturing and recurring filter revenue models remain uniquely insulated. If you value rigorous institutional-grade equity research that bypasses retail noise, hit the like button, subscribe to SR Money News, and tap the notification bell. Share your thoughts in the comments below. Is your portfolio positioned for the consumer durables shift? Thank you for watching and stay tuned for our next deep dive market intelligence briefing.